Investment fee drag is fundamentally a compounding rate problem rather than a simple subtraction problem. In any long-term investment vehicle, capital functions as a compounding engine where growth generates further growth across decades. When an expense ratio is applied, it does not merely skim the annual returns. It removes a portion of the seed capital, the base amount required for the next cycle of compounding. This permanent removal of capital alters the entire future trajectory of the portfolio. To understand the mathematical impact, consider the formula for terminal wealth, which is the compounding of the quantity, 1 plus the gross return minus the fee, raised to the power of time. This is distinct from simply subtracting a fee from the final balance. Using a gross return assumption of 10.5%, the compounding mechanics reveal a brutal reality for the investor. On an initial $10,000 investment, a seemingly minor fee differential creates a shortfall of approximately $71 in the first year. However, because that $71 is no longer available to compound, the gap expands exponentially. By year 10, the drag reaches $1,770. By year 30, the cumulative loss to the compounding engine can exceed $35,000. In this scenario, the investor has lost more than 3 times their original principal, purely due to a lower compounding rate. The objective of low-cost passive indexing is therefore an engineering solution designed to maximize the size of the capital base that remains undisturbed. By minimizing the fee, the investor ensures that the maximum possible amount of capital is permitted to compound year after year, protecting the long-term structural integrity of the portfolio's growth path.
The active management industry operates on the premise that premium fees are justified by the delivery of alpha, or excess returns above a benchmark. However, longitudinal data reveals a systemic inability for active managers to consistently fulfill this promise. According to the S&P Global SPIVA U.S. Scorecard for 2025, 79% of all active large-cap U.S. equity funds underperformed the S&P 500. This figure represents a significant increase from the 65% underperformance rate seen just 1 year prior. When the observation window is extended to a 15-year horizon, the failure rate becomes even more pronounced. Across every reported U.S. equity and fixed income category, not a single asset class showed a majority of active managers beating their respective benchmarks. In the large cap sector, underperformance rates exceeded 90%, while 82% of general investment grade bond funds failed to meet their targets. This data highlights a structural inefficiency, the near impossibility of identifying managers who can consistently outperform net of their fees. The issue is further compounded by a lack of performance persistence. The S&P Persistence Scorecard indicates that funds landing in the top half of their category in 1 year rarely maintain that position. For large-cap funds specifically, the rate of persistence is actually lower than what would be expected from pure random chance. This suggests that observed outperformance is frequently the result of statistical noise rather than repeatable skill. For the serious investor, these figures shift the burden of proof onto the active manager. Paying a premium fee for a strategy that statistically mirrors or underperforms a coin flip introduces an unnecessary and predictable drag on long-term wealth accumulation.
The true cost of a fund is often obscured because fees are deducted directly from the net asset value, or NAV, rather than appearing as an explicit invoice. The headline expense ratio is a composite of 3 primary cost centers: the management fee for portfolio decision-making, administrative costs for fund operations, and 12b-1 distribution charges used to compensate brokers. While a standard S&P 500 index fund operates with an expense ratio between 0.03% and 0.2% due to its mechanical replication rules, active funds typically range from 0.50% to 1.50%. This higher cost supports discretionary human judgment, which must be paid for regardless of the eventual performance outcome. Beyond the visible expense ratio, the weighting mechanism and turnover ratio serve as secondary engines of cost. Passive index funds generally maintain low turnover, around 3 to 5% annually, trading only when the index constituents change. In contrast, active funds often exhibit turnover rates of 50 to 100%. Every trade is a friction event. The SEC estimates that bid-ask spreads, the difference between the buy and sell prices securities, cost the average stock fund approximately 0.45% of net assets. Additionally, market impact costs occur when a fund's large orders move the market price against itself. For a high turnover fund, these hidden trading costs can add another 0.3% to 0.5% in annual drag. When combined, a fund with 100% turnover may lose 1 to 2% of its value to these frictions annually. These internal mechanics mean that the expense ratio printed on a fact sheet is merely the visible tip of a much larger cost iceberg.
Fee drag introduces a specific form of structural risk that is often ignored because it does not manifest as standard price volatility. Instead, it appears as a widening terminal wealth gap. This risk is particularly dangerous for high-income professionals because the financial impact is backloaded. In the early years of an investment, a small fee produces a negligible dollar difference, which often leads to behavioral complacency. However, because the compounding clock starts at inception, the decision to accept a higher fee in year one dictates the entire trajectory of the portfolio. By the time the wealth gap becomes substantial in later decades, the lost compounding potential is impossible to recover. This structural risk is exacerbated by a liquidity disconnect within actively managed vehicles. During periods of market stress, active managers often increase trading activity to reposition portfolios. However, market volatility is precisely when bid-ask spreads widen and liquidity diminishes. This means the friction matrix is not a static cost, it is a variable cost that spikes during the exact moment an active strategy is intended to provide value. A passive structure, by contrast, is governed by a mechanical holding rule that minimizes turnover. This provides a level of structural insulation from the stress liquidity feedback loop. In the active model, the mechanism used to justify the fee, tactical maneuvering, actually increases the hidden costs when the market is most fragile. Consequently, the investor pays the highest friction costs at the worst possible times, creating a negative correlation between active management effort and cost efficiency during market downturns. For the long-duration core of a portfolio, minimizing the expense ratio is a non-negotiable structural constraint. Any allocation to a high-fee or active vehicle must be justified by a specific structural advantage, such as access to genuinely inefficient asset classes or unique tax arbitrage mandates, rather than a generalized hope for manager skill. Strategic execution also requires careful attention to asset location. In taxable accounts, the combination of expense ratios, turnover-driven bid-ask friction, and tax leakage creates a double compounding drag. High turnover forces the realization of capital gains, which are distributed to shareholders and taxed at rates as high as 37% for short-term holdings. Because low-fee index structures generate fewer forced taxable events, they are disproportionately more valuable in taxable environments. The final verdict, based on the mathematics of compounding and the empirical evidence of manager underperformance, is clear. Over a 20 to 30-year horizon, a 0.50% to 1.00% fee differential can result in a materially different retirement outcome, often representing several years of lost income. Low-cost index structures should therefore function as the core portfolio anchor, the default allocation for the majority of an investor's capital. While active management can play a role as a tactical smart beta tilt in specific, less efficient corners of the market, such as certain fixed income or international small cap segments, the burden of proof remains high. For the core of a high-income investor's strategy, avoiding overpriced wrappers in favor of low-friction, low-cost indexing is the only mathematically rational path to maximizing terminal wealth. This approach ensures that the primary beneficiary of the market's long-term growth is the investor, not the intermediary.